Hello, RWorld, and welcome back to another episode of RWorld Talk. We are lucky enough to have Jeff Ostrowski with us today. Welcome, Jeff.
Thanks.
Nice to see you. You've been covering real estate for over 20 years, locally and nationwide. First with South Florida Business Journal, Palm Beach Post, and now currently with Bankrate. You're also an award-winning real estate journalist. Why don't you tell us how you got started and how you got started covering real estate?
Yeah, so it's been a crazy 2.5 decades of just watching the real estate cycles in Palm Beach County and South Florida nationally. So I grew up in the Midwest, studied journalism at the University of Illinois. Even back in the 90s, Florida was a fast-growing state, and it was kind of the place to be for young journalists. So I moved down here, and I guess my real introduction to real estate development, real estate reporting in Florida was kind of an unusual one. I was covering the city of Port St. Lucie, which was a booming city, but the developer who built Port St. Lucie hadn't really done the right things in terms of preparing the city for growth. So you had a city on its way to 200,000 people operating entirely on septic tanks and without proper drainage. So that was a huge story. And
say that sounds like a story.
Yeah, it was. It turned out to be many stories, many months and years of stories. So like most journalists, I wanted to be a politics writer or a music writer, write about sports. And it's it seemed like writing about a sewer project wasn't all that glamorous, but it really opened my eyes to the reality that for most people their home is a really big investment. Their quality of life is very important to them, and affordability is a big thing. So back then, Port St. Lucie was very much a working class community, and residents, homeowners were being asked to make a huge investment to make all these upgrades that should have been made by the developer to start with. But that was kind of how I got my start. And then I went on to work for those other publications you mentioned, the Business Journal and the Palm Beach Post. And I've been at Bankrate now since the beginning of the pandemic.
Okay. So many of our listeners and viewers know who you are already because of your previous works with South Florida Business Journal and with the Palm Beach Post. But why don't you tell us a little bit now what you're actually doing with Bankrate?
So I write about mortgages and housing for Bankrate. Kind of one of Bankrate's hallmarks is our weekly survey of lenders, and so that comes out every Wednesday. We survey lenders around the country about the things like CD rates, home equity line of credit rates, and the thing that I'm most interested in, and probably your viewers are most interested in, is mortgage rates. Yeah. Our number yesterday, as of yesterday's survey, the national average 30-year fixed-rate mortgage costs 7.99%, so just under 8%, and that's the highest level in our survey since August of 2000. So more than 23 years since we've had mortgage rates this high.
Wow.
And Freddie Mac's survey came out today. Theirs tracks pretty closely. Their number is a little bit lower than ours because they back out points and we include them, but the trends are the same. So they're showing 23-year highs as well.
Okay.
So that's I don't need to tell you or your viewers, but obviously the huge story of the pandemic was mortgage rates falling below 3%.
Free money.
Yes. Essentially. And now over the past couple of years, we've just had this really dramatic run up in rates. So we're now back to 8%.
Okay. So we know where the rates are and what they've been doing lately. But if you had the ability to pull out a crystal ball, we just had Dr. Elliot Eisenberg, the bowtie economist, was on here. We got his take on what he thinks are happening with mortgage rates. And then a couple of months ago, we had Emmanuel St. Germain from Choice Mortgage, and he had made his prediction. So I'd love for somebody who actually writes about what's happening in the mortgage world to give us your crystal ball opinion on what you think is possibly down the pike. What is it looking like? Are we seeing more rises on the future, or are we seeing them to start to fall back down?
Yeah,
I mean, if I could accurately predict mortgage rates, I'd be on my yacht or on my island somewhere. It's just been such a difficult thing to forecast, and so even Fannie Mae and the Mortgage Bankers Association have been steadily revising their forecasts. Even a month ago, they were saying that rates were going to be down in the 6.5% range or below by the end of the year.
Right
now, they're saying we're going to be well above 7% for the rest of the year. I guess the economy has just thrown so many wild cards. So we had
there's so many curveballs.
Exactly. Yeah, we had that that huge drop in mortgage rates that I mentioned. So at the beginning of the pandemic, Fed cut rates to zero. The Fed doesn't directly control mortgage rates. They tend to move with 10-year Treasury yields.
Right.
10-year Treasury yields plummeted pretty close to zero. I think they were down around 0.5 point. And so normally there's a spread of like 1.5 to 2 percentage points between 10-year Treasury yields and the 30-year fixed rate mortgage. So that was why we were down under 3% for mortgage rates. And then we've had a few things that have happened since then, obviously. So the vaccines became available and were effective much more quickly than anyone expected. The economy started to rebound. We still had all those trillions of dollars of stimulus sloshing around. And so all of that spiked inflation. I mean, we saw inflation get as high as 9%, highest since the early 80s. And the Federal Reserve responded by jacking up rates. They've now raised rates 12 times since last year. And that's all flowed through to mortgage rates. But it's been so hard to figure out what's happening. 9 months ago, everyone was thinking, okay, the Fed has raised rates so aggressively, that's going to have to slow the economy. We're going to go into a recession. The job market is going to slow down.
And the U.S. said, watch this.
Yeah, exactly. Yeah, mortgage rates are going to come down. Home prices are finally going to flatten out, maybe come down a little. And none of that's happened yet. So, yeah, like you said, it's the economy has its own ideas. And so that's really what's been driving this. So, I mean, we just haven't seen any kind of significant slowdown in the economy, which is good. But until there's some kind of slowdown in the economy, we're not going to see mortgage rates come back down. And so, of course, higher for longer is the mantra around the Fed, and it's also the mantra around mortgage rates, it seems. So, okay. I mean, general consensus is they're going to hit 8% and hopefully plateau there, maybe a little over 8%, and hopefully finally come down if the economy cools and the Fed starts cutting rates again.
Right.
It's just been kind of a baffling chain of events.
Well, we are seeing a lot of mortgage companies now that are starting to promote their 3-2-1 buy down products and things like that to try to stimulate some mortgage business and some home sales and things like that. And I looked at a worksheet this morning, doing something like that on a $750,000 purchase price, 20% down. You're looking with the first year of one of those 3-year buy downs, $1,200 monthly savings on the mortgage. And one thing that I learned today that I thought was really interesting was that when you do something like that and you end up getting big credit from the seller, on a purchase price like that, you're looking at about $28,000. But if you were to go and take advantage of one of those products, something that I didn't know is that when you go and refi that loan after, let's say you wait a year and the rates end up coming down, that the money that you got as the credit from the seller in order to buy down that rate is basically sitting there in a virtual escrow account that if you do go and refi, you can now use that credit that you got from the seller in order to pay for your closing costs and prepaid items on the refi, or they just cut you a check for whatever the difference is. I didn't know that. I thought that was really interesting. You've seen talking about home lenders getting creative, helping consumers get qualified and have some peace of mind. What else are you seeing that they're doing? What kind of innovative products are they trying to put out there that are really sort of trying to change the game on what's happening?
Yeah, so you mentioned the buy downs, which are one, and I thought those were innovative because I didn't realize those were a thing back in the 80s, but apparently the buy downs are buy downs are just resurrecting something that already existed. So that's one. My sense is that the buy downs have been more popular among home builders as opposed to individual sellers, but yeah, the buy downs are one. Another thing that we've been seeing a lot of is the 1% down payment mortgage. So Rocket and United Wholesale Mortgage, which are the two biggest mortgage lenders in the U.S., both have these programs where if you qualify for the Home Ready or Home Possible programs through Fannie Mae and Freddie Mac, which is a 3% down payment program, they'll cover 2% of the 3%, and then the buyer's just on the hook for 1%. And so that's been an interesting program. And I know the Rocket and United Wholesale are reporting that they're getting a lot of interest. My question about those programs is just how many people really qualify for that? Because under the guidelines of Home Ready and Home Possible, the borrower can make only 80% of the area median income. Okay. And so that means you need to have an income that's low enough to qualify, but then you also need to find a house you can afford. And with home prices still near record levels, and I think here in Palm Beach County, they're even stronger than they are in the nation as a whole. It's just I think it's tough to find a borrower who can thread that needle between being at 80% or less of the typical incomes, but then also being able to afford a home.
Yeah, with the typical climate and the way that things are going as far as home prices are concerned down here, especially in the South Florida marketplace, we're finding that a lot of the down payment assistance programs, whether that be through the state, the county, the local municipality, whatever kind of program that we could possibly get somebody into, the purchase price for the home is just simply too high. So you have people that could possibly qualify for one of those programs, but they simply just can't. They'd qualify for the program. They can't qualify for the mortgage, even with the down payment assistance, just because the purchase prices are so high. So it's almost like those programs need to catch up to the fact that incomes really haven't increased, but the home prices have increased substantially. So I think those programs really need a little bit of reworking to make sure that more people can qualify and take advantage of those pools of money that are available for them.
Yeah, home prices have increased, and then mortgage rates have increased as well, as we were just talking about. So it's really a double whammy. So you've got, you're basing your monthly debt to income calculations on not only on a home price that's higher than it's ever been, but then also on a mortgage rate that it's higher than it's been in 2 decades.
And you're saying two decades ago in South Florida, I think you had mentioned Port St. Lucie, we were seeing that there was still affordability problems back then. Mm-hmm. Okay, I wasn't living in Florida at the time, so I didn't realize that it stretched that far back.
Yeah, well, so during the boom of 2005 to 2007, affordability became a real issue, right? Because the home prices in Palm Beach County really spiked. Port St. Lucie was sort of standing in as Palm Beach County's affordable housing programs. So people who couldn't afford a home in Palm Beach County but were working in Palm Beach County would buy up there and then just endure the commute. And so I think that's still happening to an extent. It's still cheaper up in the Treasure Coast than it is here, but it is kind of a hard sell. I mean, how much time out of your life do you really want to spend on I-95, especially in an age of remote work?
Right, exactly. With so many people moving here now as well, it just traffic on 95 keeps getting worse and worse. So I think people are now looking to keep those commutes as short as possible. Do you have any advice for realtors when it comes to explaining interest rates to their clients and sort of what's happening with the market and how could they help them through that process?
Yeah, I guess the advice we try to give at Bankrate is, you just sort of have to deal with the world as it is, and so there's really nothing you can do, or there's not a lot you can do about mortgage rates. I know 9 months ago the thought was, well, maybe the things are going to slow down. Maybe you should wait for 6 months or a year in hopes that home prices would come down a little bit, mortgage rates would pull back. And of course, that's not what happened. And so the market got even less attainable to people who decided to wait it out. So yeah, I would just say the advice is, if you need a house and you can afford a house, buy the house, and then try to find some workarounds to make it more affordable. So the buy downs that you mentioned, down payment assistance, it is just a tough market to qualify, as you mentioned. But the standard advice around mortgages is make sure your credit score is as high as possible, because that's the main determinant of your mortgage rate. Make sure you shop around. Try to compare offers from at least 3 lenders. And especially when rates are as volatile as they've been over the past couple of years, that benefit from shopping around really increases. In sort of normal markets, you might save a quarter point, maybe 3/8 of a point. But Freddie Mac did some interesting research last year, finding that in times of rate volatility, those savings can really increase. So it might be as much as half a point. And not that one lender is trying to take advantage of you or screw you over, but just the volatility of the rate environment means that they're just quoting significantly different rates to the same borrower on the same day. So just be sure to shop around. And I guess don't get too hung up on rates, because there's really not that much you can do about it. If rates really do fall precipitously in the next couple of years, which no one really expects, but I mean, if that does happen, you can refinance into a cheaper rate. But it's kind of, I don't know. It's a tough market, because when rates hit 7%, everyone was sort of saying, well, home buyers and borrowers are sort of adjusting, sort of accepting this new reality, but the new reality keeps getting worse. So I don't know how well the American home buyer is really adjusting to it. I mean, we keep seeing home sales volumes fall. So definitely a lot of people are not buying just because of this combination of high prices, high rates, and affordability challenges.
So on the flip side of that coin, if you wait I always tell people, don't wait to buy real estate. Buy real estate and wait. And especially when it comes to mortgage rates, just refinance the property when the rates change. Just make sure that you can afford that payment to get through the interim until things start to change. But I would imagine that if rates were to go from 8 down to 7, down to 6, you're going to have buyers that are going to start entering the market again. We still have very limited inventory. So many people are coming down to South Florida. With that limited inventory, once you start increasing your pool of buyers that are in the market, now we're going to end up going back to one of those markets where that $600,000 house that you see listed today, that you might be able to negotiate a little bit with the seller, get a seller credit so you could use that 3-2-1 buy down sort of thing. But now if we've got a whole bunch of buyers that you're in competition with because they can now afford that rate because the rates have come down a little bit, now you're going to be back into multiple offer scenarios. So your rate's going to be a little bit better, but you're going to have to pay $650,000 for the $600,000 house because you're going to be in competition with other people.
Exactly. Yeah, and I'm glad you made that point. I just talked to Dave Liniger, the founder of RE/MAX, and he was saying the same thing, which is it's that there's still more demand than supply. But if mortgage rates do come down, then there's going to be even more demand, and exactly what you just described is going to happen. I mean, all the renters who've been waiting for their moment are going to flood into the market. I don't think we're going to see a lot of inventory. I mean, that lock-in effect, I think, is very real. A lot of homeowners have got 3%, 3.5% mortgage rates. They're not going anywhere. I mean, it just makes no sense financially to.
You'd have to really hate that house.
Exactly. Yeah, it makes no sense to swap your 3% mortgage for an 8% mortgage. And that's part of the reason that we've seen inventory levels so depressed and that we've seen home prices stay so high. There just aren't a lot of homes out there. And so I mean, it seemed like the magic number was 5%. Maybe if rates came below 5%, that would be a small enough gap to pry some homeowners out of their homes. But I mean, we're at 8% now. It's just hard to foresee a 3-point drop in the near future.
Yeah, and I don't think if anybody out there thinks that we're going back to 2% and 3% interest rates, that is just total falsity. I mean, that was so artificially deflated because of the pandemic and everything that was going on to try to stimulate the economy. We're not going to see rates like that again. So, I mean, if we get anywhere below where we are now, buy a house. It's a great time to do it, especially if you could find something that's on the market, like you said, because the inventory is so incredibly low. So you're obviously a man in the news. You follow the market closely. You've got a lot of great intel. What is one company or publisher or not Bankrate, we already know Bankrate, but besides that, an individual maybe that a realtor should be following or subscribe to so that they can get some good industry news, market updates? Obviously, we provide market updates to our members, but things that are sort of out there for the general public to hear as well.
Oh, one person. Oh, man. It's so I would say The one person whose forecasts have been really prescient is Lawrence Yun, the chief economist of the National Association of Realtors.
Yep.
And it's sort of interesting that a reporter who covered the last boom and bust would say that, because I remember Lawrence Yun's predecessor, who wasn't really trying to give accurate, unbiased forecasts. He was just trying to be a cheerleader for the industry. So his members loved him, but he wasn't necessarily giving the best forecasts. Lawrence has made a couple calls that were really spot on. So back during the depths of the recession, he was the first housing economist who was really saying that inflation is a real possibility because of all this stimulus. Everyone else was talking about deflation at that time, but he correctly called the coming inflation boom. And he didn't even say, I guarantee this. He just said it's possible, and it's logical that this could happen. And then, now that we're almost at 8% mortgage rates, he's been talking since last year about the possibility of 8% mortgage rates. Lawrence Yun has turned into a go-to, I would say. And he's a good follow on LinkedIn. He puts some good data and some of NAR's inside stats on LinkedIn. So I would say follow him. And your realtors probably already are familiar with him and are getting updates from him in their inboxes. I would say I've been impressed by the quality of his analysis and forecasting.
Sure. Yeah, I always tell people it's great to listen to a few people. If you're going to listen to Lawrence Yun's forecasts, go check out another economist's forecast as well. Compare the two and see if it looks like they're both on the same track. When sometimes they have differing opinions, you could probably bet on what they're forecasting or what they're thinking. If everybody's thinking the same thing, is their models are probably all looking very similar, and you could sort of hang your hat on something like that. But writing for Bankrate, what kinds of information are you putting out there for our members that they would be interested in? Like, what kinds of things are you writing about, and how what are you following closely?
So our audience is very much consumers. So we're giving information to home buyers, to borrowers. So the idea is that people are only buying every 5 to 10 years. They're only refinancing every few years. So they're not really experts on that particular topic.
Sure.
And so our content is geared to just hit people at their moment when they're making those decisions and trying to work their way through the process.
Well, it would be good for our people to follow you along on that journey, because if the homeowners, the home sellers, the home buyers are picking up that information from Bankrate, we sort of need to meet them where they are and find out what it is that they're reading, so that way we can have that conversation with them and know the information that they know. And if we have any objection to anything that they may be saying, or we need to have the answers to the questions that they're going to have if they end up finding something out on Bankrate.
And so we're focused, like I mentioned, our weekly rate survey. So we publish that every week. And then we're sort of just focused on very actionable, basic news about what kind of loan should you get, or how do you navigate the mortgage process to make sure you're getting the best deal.
Okay.
And then also, how do you navigate the home buying process? How do you sort of figure out how to buy a house at a time when home prices are just so expensive compared to incomes for many people.
Yeah, it's wild. I know just about 5 years ago, $500,000 home, you're looking at a $3,000 mortgage, and nowadays you're looking at a $350,000 home and a $3,500 a month payment. It's just it's crazy that you're spending so much less on a property, but at the same time your monthly payment is so much higher just due to it doesn't seem like that big of an increase in rate going from 5% to 8%. You're talking about 3%, but 3%, but that small difference in that number has just had like a major impact on your monthly payment.
Yes,
it's crazy. So we ask all of our guests this last question. I know you're busy guys, so we're going to let you get out of here. What is a local gem or a little South Florida hotspot that you absolutely love that we need to visit? Could be a restaurant, a beach, anything that you love about South Florida.
Yeah, okay. So I will say that I recently went snorkeling at MacArthur State Park for the first time in a long time, and I would recommend that to everybody. I don't know if you've been there, but that's the state park in Palm Beach Gardens. It's on the ocean. To get over to the beach, you have to take this long walk across a boardwalk with a lagoon. But yeah, I would say that's it's just very relaxing. You're in the middle of a major metro area, but it feels like if you don't look at the condo towers, up and down the beach, you can, you sort of feel like you're back in old Florida.
Like you're in old Florida. Beautiful. MacArthur State Park. You guys heard it here. Well, Jeff, thank you so much. It was absolutely a pleasure having you. Glad that we got to pick your brain for a little bit, find out exactly what it is that you're about and what's going on with the mortgage world. Certainly happy to have you here. So thank you so much for your time.
All right. Well, thank you. Enjoyed it.
And for you guys, we will see you right back here next time on RWorld Talk.